Welcome back to the deep dive. Today we're jumping into a really fascinating, maybe even a bit confusing company. Take-Two Interactive Software, that's ticker TTWO. We've gathered the key data as of October 9th, 2025. The share price closed at $258.07. And our goal today, well, it's pretty straightforward. Cut through all the market chatter, the hype, and figure out if Take-Two can actually realistically justify this, frankly, breathtaking valuation it has right now, because when you dig into the source material, there's this fundamental clash. The financials, I mean, they look pretty damaged right now, but the stock price, it's basically signaling guaranteed massive success. It's just around the corner. So the whole thing really seems to hinge on one huge high stakes question. Is the market actually rational here, ignoring the current negatives and betting everything, everything, on the flawless success of one single game? Yeah, the one we're all thinking about, Grand Theft Auto the Sixth.
It really is the ultimate binary bet at the moment, isn't it? The difference between this stock flying or flopping feels like it rests entirely on, 215 million copies of a game that's not even out yet. So let's start by grounding ourselves in the current reality. Part 1, the fundamentals and the damage.
Okay, so the first thing you really need to grasp about Take-Two is, well, they're not the same company they were, say, a decade ago.
Yeah.
They made a really crucial shift, right? Moving away from just selling physical games in boxes.
Exactly. They pivoted hard towards a digitally focused model. It's all about long-term engagement now. And that model is, it's entirely built around recurrent consumer spending, or RCS, as they call it. This stuff is the company's high-margin lifeblood.
Right, so RCS is like virtual currency, like the shark cards in GTA Online.
Yeah.
And downloadable content, subscriptions, all of it.
Precisely, all of it. And this digital revenue stream, it's projected to be, get this, 78% of their net bookings in fiscal year 2025.
That's huge.
If they pull it off, it completely changes their revenue profile from being, lumpy and hit-driven to something much more predictable and hopefully recurring.
And that predictability, I guess, is built on some incredibly strong brands, some serious IP. Rockstar Games is obviously the crown jewel here.
No question. Grand Theft Auto.
Mm-hmm.
The franchise has sold, over 385 million units globally?
Yeah.
That's mind-boggling.
And GTA V alone, the last one, is over 215 million units sold. I mean, that's just generational success.
Mm-hmm. Absolutely. But they do have other important pillars. It's not just GTA. The 2K label, for instance. They dominate sports with NBA 2K. Plus, they have really strong franchises like Borderlands, BioShock, Civilization.
Right. Good point. We can't forget Zynga, can we? That massive acquisition.
Definitely can't forget Zynga. A $12.7 billion deal back in 2022. It instantly made mobile gaming their biggest segment. Something like 54% of revenue in the third quarter of fiscal 25 came from mobile.
So their core value proposition isn't just selling games once, is it? It's much more evolved now.
Not at all. It's really about delivering these culturally huge interactive entertainment experiences, and then cultivating these massive franchises so they can monetize them for decades. They build these enormous worlds, and then they work hard to make sure those worlds feel alive enough that you actually keep paying to play in them for years and years.
Okay, so who's steering the ship? The CEO is Strauss Zelnick. He's got this legendary reputation, right? A turnaround specialist.
Yeah, his track record is pretty notable. Back around 2007, Take-Two was kind of a mess. They had government investigations, financial problems, and Zelnick, along with President Karl Slatoff, they came in, sorted things out, really focused on empowering the creative talent.
And that laid the groundwork for the big hits later on.
Exactly. And their capital allocation strategy sort of reflects that history. It's very aggressive, very growth-oriented. They keep all their earnings, so no dividend for shareholders. Keep that in mind. And they pour that cash back into massive internal projects.
Like the budget for GTO VI. The numbers floating around are just astronomical.
Right. The budget is, it's reportedly over $2 billion. I mean, think about that for a second. $2 billion? That's more like what you'd expect a major Hollywood studio to spend on their entire slate of movies for a year, not on a single game. It's unprecedented.
But hang on, he's known as this turnaround guy, right? How do we square that reputation with what looks like a massive critical failure in how they spent their money recently? I mean, the Zynga deal, the numbers look pretty bad.
Yeah, that's the elephant in the room, isn't it? The evidence is, it's quite damning when you look at it. Take return on invested capital, ROIC. Basically, how well does management use the money they invest?
Okay.
In fiscal 2021, before Zynga, they had a strong ROIC, 19.3%. Pretty good. But after the Zynga deal closed, it collapsed, utterly collapsed, to negative 5.3% in fiscal 2025.
Negative 5.3%.
Negative. And here's the crucial thing to understand. When ROIC was 19%, every dollar they invested theoretically made them 19 cents back. Now at negative 5%, every dollar they invest destroys 5 cents of shareholder value. They're actively burning value right now.
Wow. Okay, so that's pretty stark. And there was that huge write-down, wasn't there? A $3.55 billion charge? What exactly was that?
Yes. That was a goodwill impairment charge.
Yeah.
Okay, so simplifying the jargon. Goodwill is basically the extra money you pay for a company above its actual asset value. It's like paying for the brand, the potential, the intangible stuff.
Got it.
Taking a $3.55 billion impairment charge on that goodwill is basically management having to admit, officially, on paper, oops, we overpaid for Zynga by billions almost immediately after buying.
Ouch.
Yeah. And that failure is a big reason why they've stopped buying back shares and why they don't pay a dividend. They need to hang on to every bit of cash they can to stabilize things after that misstep.
Okay, so that management fumbles directly into the overall financial health, or maybe lack thereof. The company has a market cap of about $48 billion. And yeah, the 5-year revenue growth looks okay on the surface, 12.77%, but like you said, that's mostly just because they added Zynga's revenue in, right?
Exactly. That number is heavily skewed by the acquisition timing. The real story, the confusing part, is in the profit margins. And this is where you see this stark contrast.
How so?
Well, the gross margin is fantastic, really robust, 54.36%. That tells you their core products, the games themselves, are premium and they have pricing power. People willing to pay top dollar. That part's great.
Okay, good start.
But then you look further down the income statement, the operating margin. It plunged to negative 77.94%. And the net margin, right there with it, a staggering negative 79.50%.
Whoa, okay. Can you help us picture that? If the gross margin is healthy, like the product itself is great and sells well, but the net margin is just terrible, what does that actually tell us about how the company's running?
It's like, imagine they own the most popular, highest rated restaurant in the world. Every dish is perfect. People line up for blocks. That's the gross margin. But their rent is astronomical. Their R&D for new recipes costs a fortune. And maybe they made a terrible decision buying another restaurant chain that failed, like Zynga.
Right.
All those overhead costs, the R&D spending, those huge write-downs, they're so incredibly high that despite selling amazing food, they're losing money hand over fist.
Got it. That makes sense.
And that margin collapse led directly to that massive loss we mentioned, a GAAP net loss of $4.48 billion in fiscal 2025. That works out to a loss per share of $25.58.
Yeah.
Just a catastrophe that broke a long streak of them actually making money.
And with all that spending, especially on GTA ZA, they must be burning through cash.
Precisely. Their free cash flow, FCF, is negative right now. Negative $58.3 million over the last 12 months. They're literally spending more cash than they're bringing in, mostly to fund that huge development pipeline.
And the debt.
Yep, the Zynga deal needed financing, so that pushed their debt-to-equity ratio way up to over 100%, 100.75% specifically. And their short-term liquidity, measured by the current ratio, it's kind of thin at 1.1C, not much wiggle room there. Which logically brings us to part two, the speculation and the verdict. If the current financials are this challenged, why on earth is the stock trading way up at $258?
Yeah, that's a big question. And the answer seems to be just pure, unadulterated hope for the future, right?
Yes.
Speculation.
Absolutely. The valuation metrics scream it. Their trailing PE ratio, it's negative 10.8, totally useless because they're losing money. But the forward PE, looking ahead, it's incredibly high, over 48. That tells you the market is completely ignoring last year and basically shouting, we believe the windfall is coming.
And Wall Street seems to be leading that charge.
Oh, yeah. The analyst consensus is overwhelmingly strong buy. You've got 20 analysts covering it, 19 say buy, 1 says hold, and literally 0 say sell.
0 sells. Wow.
0 sells. The average price target for the next 12 months is around $269.53. So, okay, maybe only modest upside from where it is now, but the conviction behind that rating is just immense. Everyone seems to be on board.
And the stock chart itself, the technical picture, it seems to back that up.
It does. The stock's trading well above its 50-day moving average, which is around $238, and comfortably above the 200-day average near $220. From a technical perspective, it's a confirmed strong uptrend. But, an uptrend driven entirely by expectation, not current reality.
Right. So summing it up, the market price is almost totally disconnected from the current weak fundamentals. It's all about the future narrative of GTA 6.
Exactly. It is the absolute definition of a conviction trade, a trade built almost entirely on hope.
So who exactly is making this big bet? Who owns the stock?
Well, it's overwhelmingly large institutions. We're talking about 94%, maybe even 95.5% of the shares are held by institutional investors.
Like the big names.
Yeah.
Vanguard, BlackRock.
Yep. Vanguard, BlackRock, even the Saudi Public Investment Fund is a major holder. It's what you'd call a crowded trade. All the big money managers seem to own it.
Okay, so the big funds are piling in, but
Yeah.
what about the insiders, the people running the company?
Now that's where things get interesting, because we see a pretty crucial divergence here. While the giant institutions are buying or holding, the executives, the CFO, the president, the chief legal officer, the people who really know what's going on inside, they've actually been net sellers.
Net sellers, meaning they're selling more than they're buying.
Correct. Over the last 12 months, insiders have sold net over 532,000 shares. And importantly, there haven't been any corresponding open market purchases by these key insiders during that time.
Huh. That feels like the real kicker, doesn't it? You've got the entire market, Wall Street, big institutions all roaring with optimism. And the people closest to the actual business are quietly selling shares, taking some chips off the table.
It's definitely a contrast. Now, insider selling can happen for lots of reasons, personal finances, diversification, whatever. But a consistent pattern of net selling, especially from the top brass, without any buying, it's kind of a quiet signal of caution that really stands out against the market's loud bullishness.
A quiet signal of caution. I like that framing. Okay, let's try and structure all these risks and potential rewards. Maybe a quick SWOT analysis. Strengths, weaknesses, opportunities, threats.
Yeah, that works well here. So the strengths S are pretty clear, right? You've got that absolutely unrivaled IP, mainly GTA, and they've proven they're good at the live services stuff, driving that high margin RCS.
Okay, strong IP, good recurring revenue engine. What about weaknesses?
The weaknesses W are just as significant, I'd argue. The biggest one is extreme franchise concentration. I mean, 70% of their game sales from just two franchises, GTA and NBA 2K, that's incredibly risky.
70%. Wow, that's high.
Very high. And then you add in the current financial weaknesses we talked about,
Right.
the negative free cash flow, that collapsed ROIC from the Zynga deal. Those internal limitations are severe right now.
Makes sense. Opportunities. Is it just one big one?
Pretty much. The opportunities are almost entirely laser-focused on one single event, the GTA VUI launch. That is the monumental, company-defining catalyst. Everything hinges on it.
Okay. And finally, threats. What external factors could derail things?
Well, the threats at T are quite serious and mostly external. There's growing regulatory heat. You have things like the EU's Digital Markets Act, possibly messing with the App Store commissions, that 30% cut they rely on. And regulators everywhere are looking much harder at things like loot boxes and how games are monetized.
Right. The regulatory landscape is definitely shifting.
And then there are the broader macroeconomic pressures, rising costs, maybe tariffs impacting hardware or production. If they have to absorb those costs instead of passing them on to consumers because prices are already high, that could squeeze their margins even further.
So regulatory scrutiny and margin pressure from the economy.
Got it. All right, let's bring it all together. Time for the final synthesis. The bull case seems pretty straightforward. Iconic brand, the almost guaranteed massive sales from GTA ZS, and yeah, those high gross margins show the underlying product is desirable.
That's the bull side. But the bear case is just as compelling, maybe more so based on today's reality. You've got record losses happening right now, the undeniable failure of the Zynga acquisition strategy, that incredibly dangerous concentration risk on just two franchises, and crucially, what looks like zero margin of safety in the current stock price.
So it comes back to valuation. Did you run any models, like a discounted cash flow, to try and estimate intrinsic value?
We did. We ran a DCF analysis, but you have to understand the output from that model is extremely sensitive to whatever assumptions you make about the GTA V launch when it happens, how many copies it sells, how much RCS it generates. Change those assumptions slightly, and the value changes dramatically.
Okay, understood. But with reasonable assumptions, what kind of range did you get? Based on our modeling, The estimated intrinsic value range for TTWO falls somewhere approximately between $171 and $250 per share.
$171 to $252. Okay. And let's remind everyone, the share price as we record this is $258.07.
Exactly. So when you compare our analysis to the market reality, the current stock price is trading slightly above even the high end of our estimated intrinsic value range.
Which leads to the final thought, I suppose.
Yeah, the final thought is this. Putting your money into TTWO at this price isn't really a value investment based on what the company is earning or doing right now. It's much more like a highly speculative bet.
Yeah.
You're betting that GTAVI will not only meet the already monumental expectations, but actually exceed them, because perfection, or close to it, seems to be fully baked into the stock price already.
A speculative bet on exceeding perfection. That sums it up well. So here's something for you, the listener, to think about. If Take-Two is indeed operating without a margin of safety right now, what happens to all that market conviction, that high stock price? If the massive financial windfall everyone expects from Grand Theft Auto VI gets delayed by even just one single quarter, mull that one over. And hey, if you found this deep dive useful, please remember you can get priority access to analyses like this on all the S&P 500 stocks. Just like and subscribe to Stock Analytics AI. Memberships are only $4.99 a month. We're covering the whole S&P 500 over the next few months, and members get that exclusive priority access. Or, if you just want a deep dive on one specific company, drop us a super thanks. We appreciate the support.
And the necessary reminder, this analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be taken as financial advice. Please, always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.